Welcome to this BPT class. My name's Kieran Doe. I'm a senior tutor at ACA Masters and multiple ICAEW prize winner. In this class, we're going to look at an exam question focusing on family investment companies and trusts. This class is taken from our BPT video course. Further details for this course and other sample classes can be found on the BPT page of the ACA Masters website. So www.acamasters.com and then head down to the BPT page. Here you will find further details for our video course and our BPT materials, including free samples. There's also other useful advice and tips on how to pass your BPT exam on the exam tips page of the ACA Masters website. So this question is a question 3. It's worth 25 marks. So it looks as though it's a single requirement. So unlike some of the other BPT questions, we're not going to have to think as much here about our mark allocation and our time allocation. It looks as though there is just one requirement. So explain the tax implications of the two alternatives set out in Anna's email. So presumably we've got an email down here, and here we have Exhibit 1, email sent to your firm by Anna Ryan, and we've got about a page of information there. And clearly we can see we've got two alternatives to work through here. So actually we might decide that we do want to allocate our time, well, allocate the marks and then allocate the time between the two alternatives. Perhaps there will be a bit more to do for alternative 1. Looks as though there's more numbers here. There's a bit more information. So maybe do 15 marks for alternative 1 and 10 marks for alternative 2. So allocate the marks that way and then do your minutes per mark based on that. So you've got your minutes per mark, multiply that by the marks for each. So 15 marks for the first part, 10 marks for the second part, multiplied by the 1.5 minutes per mark will give us a time that we're going to spend on each section. Now, as I've said before in previous classes, this doesn't have to be exact in terms of your mark allocation. It's just kind of a rough estimate of what the marks will be so that you can spend roughly the appropriate amount of time, and perhaps more importantly, making sure you don't overrun on the first bit so that you leave enough time to get on to alternative 2. There's usually easy, medium and hard marks on each question, and also each part to each question. So we want to make sure we get all the easy and medium marks. So, we want to get all the easy and medium marks here. And rather than spending time trying to get the really hard bits, we'll instead move on and make sure we get all the easy and medium bits here. And that will ensure that we'll pass with a really good mark. So as always, I look at the requirement, I look at the exhibits, I think about how I'm going to allocate my time, and then I'll start reading through the scenario. We can now read it a little bit more actively because we know kind of roughly what we need to do. So we're a trainee ICAEW accountant working for a firm of ICAEW accountants. So Anna Ryan, who sent the email, an existing client has approached your firm for advice. So Anna is married to Kira and they have twin children, Lexi and Ty, who are 17 years old. So we can see who we've got here. We're looking at all individuals. So married couple there, so spouses, 2 children, and we're told their age. Anna runs a successful business, and as a result, she has accumulated substantial assets. Anna and Kira are planning for their family's future and would like to start passing assets and income to their children. So quite a typical kind of CGT, IHT type question. We've got some individuals with assets. They're looking to pass them on to their children. So we've seen this type of question lots of times before. So Anna has sent an email explaining the family circumstances and the 2 methods of passing assets to her children, as we've seen in Exhibit 1. Anna needs to know the tax implications of each method. So here we've got the exhibit, and then we've got the 2 alternatives. So this is the email from Anna. My children will be turning 18 next year, So now is the time to start planning for their future. I want to provide them with a regular income to support them through their education and training. So wants to provide them with a regular income. So remember with our answers, as I always do, always apply it to the scenario as much as possible. So wants them to have regular income throughout their education and training. I also want to ensure that they have access to capital should they want to start their own businesses or purchase a home. However, whilst they are relatively young, I want to retain control over when amounts are paid to them. After doing some research, I've identified two alternatives. So clearly we've got the parents effectively in this situation. It sounds as though one of them's got most of the assets as far as we know, but they want to start passing some assets on to their children and giving them some income. So we've got alternative one. So set up a family investment company. So a new company, Court Limited, will be set up and I will transfer cash of 200,000 to Kira, so spouse, and the two children, so that we can each subscribe to £2,100 shares. So it sounds as though she's going to transfer cash of 200,000 to each of them so that they can each subscribe to 200,000 of share capital, so setting up a company. Only my shares and Kira's shares will have voting rights. All shares will have equal rights to dividends. Kira and I will be the company directors. So you can see what they are suggesting to do here is that, we've got Anna here, the individual who owns, assets, and they're going to set up a company and they're each going to have shares in the company. But we can see here that only the parents' shares will have voting rights. So they'll have control over the company. They're also going to be the directors as well. So they're going to have, day-to-day control over the company. And they've also got the shares with the voting rights as well. Sounds so the children's shares, don't have voting rights, although they do have rights to receive dividends. So the first issue we've got is Anna's going to be transferring cash to each of her children and to also her wife. So that's something we're going to have to think about there. So that's the first bit. Maybe we'll just have a quick read through to see what else is going to happen. I will transfer a buy-to-let property I own to Court Limited. So she also owns a property. She's going to transfer that into the company. So we've got an individual disposing of a property. Clearly, that's going to be CGT again there. The cash will be exempt from CGT, but there could, of course, be IHT implications there, transferring that to other individuals. Obviously not to the spouse because that will be exempt, but we'll come back to that. Property has a market value of 390k, earns rental income of 12,000 a year. I purchased a property in 2016 for this amount. So we know the base cost when she purchased it. We know the market value. Obviously, it's being transferred to a connected party in a company that she controls. So Court Limited will use the cash of 800,000. So it's getting the 800,000 because they're each subscribing to share capital of 200,000. So the company's going to have 800,000 in it to buy shares in companies that regularly pay dividends. So the company's going to buy shares in other companies that pay dividends. So it's going to, acquire shares in, other companies and then receive dividends from those companies. Of course, we know a company receiving dividends, that's going to be, exempt for corporation tax. I expect annual dividend income will be 38,000. So the company's going to have dividend income of this. All income earned by the company will be paid out to us as dividends. Kira, Lexi and Ty do not have any other income. So obviously the company's going to have cash in it and then that needs to be extracted by the shareholders and they're each going to receive some dividends. I have annual income of 250,000 from my partnership business. So clearly, this is Anna has got trading income. So in her income tax computation, she's obviously got trading income in there and is clearly an additional rate taxpayer, has lost the personal allowance, etc. So she's an additional rate taxpayer, but the others don't have any income. So the others will all have their personal allowances available to use, and then their basic rate band. So when Lexi and Ty, so the children, want to start their own business or purchase a property, the company will sell some of the assets to provide the necessary cash. So when the children want to buy a house or set up their own business in the future, the company's going to sell some of these assets. Obviously, the company's going to end up having this property and all of these investments in other companies in there as well as some cash, or I think it said they were going to pay all the cash out as dividends, but have all of these investments that the company owns. So they'll sell some of those and then pay an extra dividend out, presumably to the children. Once the children are established in life, Kira and I will transfer our shares to them. So the parents have got their shares, but then they'll transfer their shares to the children. However, I am unsure whether we should transfer our shares in our lifetime or on death via our wills. And as we've seen in previous CGT and IHC questions, during the video course, this is a common area we need to advise on. Should they transfer them, during life, or should they transfer them on death? And we always need to think, CGT and IHT. So we can kind of see what's going on here. I mean, let's not look at alternative 2 yet. Let's just take it one alternative at a time. So we've got alternative 1 first of all, or method 1. So we'll deal with this one first, and there's clearly quite a lot going on here, but I would just take it, one at a time. As I've said before, it's quite easy to read all that and just be kind of completely overwhelmed and start thinking, well, I think I know something about lifetime transfers and death transfers, and how should they do this, and I haven't seen this type of asset before, or it's complicated because there's a company involved. But just always kind of start with the basics, take it kind of one transaction at a time, think of all of the relevant taxes as we go through. So the first thing is they're going to set up a new company, transfer cash of 200,000 firstly to the wife and then to the 2 children. So, I mean, that's the first thing we need to think about first of all, because we've got this individual is transferring cash firstly to the spouse. So that's quite easy to deal with. So whenever we're looking at kind of capital transactions, we always want to be thinking CGT and IHT. So whenever we're thinking about individuals passing their assets on, we always need to think CGT and IHT. So this is a lifetime transfer, clearly, because she's alive and well, as far as we know. So she's passing it on in life. So what would it be for CGT? Well, of course, cash is exempt, and also transferring it to her wife. So it's obviously exempt because it's being transferred to the wife. So it's exempt in both ways. So that's quite straightforward. So we could say a transfer of cash to wife will be exempt for CGT, or in fact, you could say transfer of cash to wife and children will be exempt for CGT, and you could put due to, or we could just say because cash is exempt asset for CGT. So always think, does an exemption apply first of all before you start thinking about the reliefs and then finally applying the tax? So that's kind of quite straightforward there. But then what about inheritance tax? So, inheritance tax, lifetime transfer. Remember, there aren't really any specific assets that are just exempt from inheritance tax. Yes, there might be some reliefs, but there aren't any particular assets. If it's being transferred to a spouse, though, similar with CGT, obviously that's exempt. So that's quite straightforward from IHT. So you could say transfer of cash to wife will be exempt for IHT as spouse transfer. So that bit's quite straightforward, but it's more complicated with the children. Obviously, that doesn't come under the spouse exemption. So is there like a specific exemption there? Not really. There is the annual exemption, or possibly a marriage exemption, but they're not getting married. We're not told this is just like a normal payments made from income. So therefore, we'd say transfer to children. So therefore, what type of transfer would this be for IHT? It's not exempt. there isn't a particular relief. This isn't business property. This isn't this isn't her like partnership business or shares in a trading company. This is just cash. So therefore, it's going to be a PET. It'd be a CLT, of course, if it was going into a trust, which it isn't. Looks as though we might be looking at that for the second part, though. So it's just a transfer, directly to the children. It's not a CLT, and therefore it's a PET. So therefore, that will be a PET. And of course, we know, the PET. There's no lifetime tax. I mean, there's a nil rate ban, but there's no lifetime tax, and it'll only be tax if she dies within 7 years. So transfer to children will be a PET. And then we could make some of those more general points now. So you could say, annual exemption of 3K will be available, and you could put, and 3K for, prior year if, if unused, maybe the quickest way to put that, but if she hasn't made that transfer in the previous year. So the annual exemption of 3K will be available, nil rate band of 325K available. So it wouldn't cover both transfers, but it would kind of cover at least one of them. But then just remember as well, there'll be no IHT to pay if she survives 7 years. So you put, no lifetime tax to pay, and no death tax if survives 7 years. So that's why it's usually good to give things away in lifetime for IHT, because if the individual survives 7 years, then there isn't going to be IHT. With a PET, obviously with a CLT, there's that life tax to pay. With a PET, if you survive 7 years, that's it. It's out of the scope of IHT. And of course, there's taper relief. So as long as you survive 3 years, then of course, then they'll get taper relief. So no life tax to pay and no death tax if survived 7 years. And you could put, taper relief from, 3 years. It doesn't sound as though, sometimes in the question they might tell you the individual's ill and they've only got however long to live. But there's no mention of any of this here. They're still working. They've got quite young children. There's no mention of ill health, so should be able to survive that period. So we have mentioned that then on the transfer to the children. So that's going to be a PET for IHT. So that's kind of the first part dealt with. So that's all quite straightforward, really. That's just TC knowledge. So that's the first transfer. Then they're each going to buy the shares. And as we said, only these two will have voting rights. So they've got control over the company. And we were told that in the scenario that she wanted to retain control over these assets. So it's in a company which she and her wife controls, and they're the directors. So they're responsible for the day-to-day operating of the business. Shares of equal rights to dividends will be the company directors. So I will transfer a buy-to-let property I own to the company. We're told what the market value is. Rental income of this. I purchased the property for this amount. So she owns this asset. She's going to dispose of it to the company. And then again, we're thinking that she's disposing of another asset. She disposed of cash to wife and children. Now she's disposing of a property to a company, which of course is, a connected party in it, and it's a gift effectively. So it's for no consideration as far as we're told. So again, now let's think CGT. A house definitely isn't an exempt asset. Transferring it to a company is not like an exempt transferee. Yes, there would be the annual exemption if that is available, if she hasn't used the annual exemption. But then we can think, are there any reliefs available? So we could start off first of all. So we could say transfer of residential property to Limited Co. Will give rise to chargeable gain subject to CGT, or gain subject to CGT. Are there any reliefs available? So, as I covered in the CGT class, always think whenever you do a gain, proceeds minus cost equals gain. And we can do this first of all. Let's calculate the gain. We know that the proceeds, which will be at market value, it's to a connected party minus the cost equals the gain. So we've got the proceeds 390,000. The cost, I think it was 292. So we've got 292 for the cost. And then we've got the gain on the property. And yes, we'd be able to deduct the annual exemption. And we should always confirm as well when we've got some information, if there's some information that's missing, we could just say, need to confirm if annual exemption available, hasn't been used. So then you'd have the gain, but then always stop. When you do proceeds minus cost equals gain, even before you do the annual exemption, just always stop and think, is there a relief available? Quite common in the BPT exam, we see, are there any reliefs available? So rollover relief, is that it's not a trading asset, and this is the issue we're going to have here. Most of these reliefs are for trading assets. So are they disposing of a trading asset and buying another trading asset? No, it's not a trading asset. This is an investment asset. It's a buy-to-let property, so that kind of passive income. Gift relief as well, that's for trading assets. Now, there is that special type of gift relief if it was also subject to an IHT charge, or if it was a CLT and there was going to be a gain for CGT, then it can be deferred under that special type of gift relief. There's no mention about reinvesting in EIS shares. I'm not told about any previous gains deferred over against that property. It would be unlikely with a residential property. So none of the tax deferral reliefs available. So the reliefs which defer the tax charge. So we went through this in detail in the CGT classes. But the tax deferral reliefs where you actually just get to defer the tax charge. Are there any other tax rate reduction reliefs on business asset disposal relief, again, on trading assets, on business assets? And, we're not talking about shares in a company here. So in terms of tax exemption reliefs, the best ones, the ones that exempt the gain, obviously PRR would be the one here, but we're not told that she's ever lived in the property or anything like that. So it doesn't seem to be, available there. That would be the main one we're looking at here of residential property. So it doesn't seem as though there's any reliefs available. I mean, you could put that, need to confirm if annual exemption available and if ever lived in the property. We're told it's a buy-to-let property. If they had lived in there at some point, then possibly they'd be able to claim some PRR on that. So, we said it's going to give rise to a gain. Doesn't look as though there's any reliefs available. And like I said, it's usually for trading assets. If you think about those reliefs, they almost all apply to trading assets. We know that she's an additional rate taxpayer, so therefore we're paying CGT at the higher rate. So just use the relevant rate for that, which of course we would be looking at 20%, 28% here for CGT. Just remember that there's additional rates for residential property. So we're looking at 28% CGT on that. Once we've obviously deducted the annual exemption relevant for your exam. And then we would have the CGT that would be payable on that. So then you can copy that over into the word processing area. So that's going to give rise to a capital gain as she transfers that property into the company. So would there be any other taxes which are relevant? Well, of course, stamp duty would be payable by the company. So stamp duty, land tax payable by the company. And you could go through and you could go to Hardman's and get the rates and work out exactly what the stamp duty would be there on that property. And of course, there would be the additional rates as well. So when we thought about this, remember that common exam scenario of how do we set the business up? Should we set it up as an unincorporated business or an incorporated business? Remember, we said with an incorporated business, there'll always be that additional 3% stamp duty charge as well. So the stamp duty payable by the company, and making sure you include that additional 3% in there. ATED's not going to apply because of the value of the property. 15% stamp duty is not going to apply. It's not more than that. So again, some other points worth considering there. So that's the transfer of the property into the company. There's not going to be any IHT because it's going to a company. It's not going to another individual. No, IHT is a personal tax. So you could briefly mention that, no IHT. I think it's always good to get into that habit when you're looking at capital assets, thinking the CGT and IHT, and just throughout really thinking of all the other taxes which might be relevant. I mean, the other small ones would be VAT and national insurance. Obviously, no VAT on residential property. You could possibly mention that, might get you a mark, but no IHT as not a transfer to individual, or no IHT as, should put this as transfer to a company. And you could possibly have made that point about VAT, but we want to get through the main bits of the question really, rather than just kind of listing out lots of different points. We're not even that far through it yet, and we've already got lots of points down. So let's try to stick to the main ones as much as possible. So then we've got that first bit, transfers of property into the company. So what we've ended up with now is that the company's got property in it and it's got the cash in it as well, because they subscribe to the shares. So they transferred, some cash to the wife and the two children. So they all had cash, and then they subscribed to the shares. So they put their money in the company in exchange for shares. So all the money now is in the company, as is the property. We're told what the rental income is, so they're going to use the cash to buy dividends. So the company is going to be earning property income, and it's going to be receiving dividends as well from these share investments that it's bought. We're told the amounts, and then we're told income earned by the company will be paid out to us as dividends. So, as we discussed, in detail in that class, when we're looking at how to set up a business, set it up as an unincorporated business or an incorporated business, explaining in great detail. When we've got a company, of course, the assets belong to the company, the income's earned by the company, and therefore the company, because it's a company, pays corporation tax. So therefore the company's going to have rental income and dividends, and it's going to pay corporation tax. Now, of course, we know for corporation tax, rental income is going to be taxed as property income, and dividends are exempt in almost all cases. And there's nothing here to suggest that these dividends wouldn't be exempt. So we could say here, rental income of 12k earned by Limited Co will be subject to corporation tax. And then we could say dividends are exempt from corporation tax. And we were told the dividends, I think they were quite nice with the numbers, 38k, so that we know that the total income earned by the company is going to be 50k. So of course we're thinking, okay, what does the corporation tax computation look like for the company? Well, it's got the property income. We're not told about a mortgage on the property, but if there was one, remember this is like deductible for companies. So it's deductible as a non-trade loan relationship. So non-trading interest payable. Of course, that's more favorable than for individuals, because individuals, it gets kind of restricted. And you only get kind of 20% effectively of the interest, unless it's capped by something else. So, a company gets to, offset the interest in full, whereas an individual has it kind of restricted to the basic rate of tax. So when we're thinking about this company, obviously it's going to have property income. So we're going to have, in the company, it's going to have property income of 12,000. It's going to have the dividends, obviously, as we've said, these are exempt. And then, that's what's going to be subject to corporation tax. So you might be looking at this and thinking, okay, well, therefore they're going to be paying corporation tax at the lower rate. But just remember, this is a closed company. And one of the points we said when we looked at closed companies was that if it's an investment company, then corporation tax is at the main rate, regardless of the level of profits. Is this a closed company? Well, is it controlled by 5 or fewer participators? Clearly, yes. Controlled by 4, and they're all associates anyway, so it's effectively controlled by 1. So going to be paying corporation tax at the main rates on those profits. Maybe a bit of a tricky point to pick up there. So that would be the corporation tax that would be payable. So 3K there on the corporation tax. So you could mention this here. Corporation tax will be at main rate because it's a close investment holding company. That's a hard point, I think, to pick that up. With everything else going on in the scenario, that's probably a hard point. If you use 19%, you still get plenty of credit. Got the easy bits here: rental income, property income taxable. Dividends are exempt. You could even make that point as well. Interest deductible as NTLR. Dividends will be exempt. Corporation tax will be at the main rate. So then it said income earned by the company will be paid out as dividends. We know these three don't have any other income, where Anna herself is an additional rate taxpayer. So we know the company is going to receive dividends. It's going to have cash coming in from the dividends. It's going to have cash coming in from the rent, and then that's going to be paid up as a dividend. So we can say dividends received subject to income tax. So you could actually be quite clever here. You could actually work out the amount of the dividend that they're going to receive each, because the company is going to have, the rental income of the 12,000 coming in. It's going to have the dividends coming in. I guess we need a total amount of 50,000. Could have started that with this. It's going to pay corporation tax of 3,000, and therefore that's going to leave 47,000 out as a dividend available to pay. And then there's four of them. It said that all the shares they've subscribed to an equal amount of shares, and all the shares have voting rights. So therefore that would be the dividend that they would receive each. And clearly for these three who have no other income, clearly that means that they're not going to pay any tax on that, because it's going to all fall within the personal allowance. So yes, they're going to have dividend income in their income tax computation, but it's all going to be covered by the personal allowance. So we could put, it was Kira, Lexi, and Ties will have no income tax to pay because dividends below personal allowance. And then we could put Anna will pay income tax at additional rate for dividends, as she's an additional rate taxpayer. And then you could work out what that would be. So get the additional rate for dividends and then multiply that by the dividend, which we worked out, and just making sure that we copy this over to the word processing area, making sure we get credit for that. That'd be quite easy. Just go to the dividend rate relevant for your exam and then work out what that would be. So then you could see how much tax would be paid overall. So a bit of corporation tax in the company, but only on that rental income. And then there would be a small amount of income tax, but only on Anna, because all of the others fall within the personal allowance. And there is one small point to pick up on. It did say here that the children are currently 17. If they receive this income before they're 18, it'll be taxed on the parents. But if they receive it once they're 18, they're an adult, they're effectively seen as independent, so it'll be taxed on them. So you could put here dividends subject to income tax, have no income tax to pay. And then we could put here, assuming dividends paid out once children are 18, otherwise dividends taxed on the parents, because otherwise this is effectively to stop people shifting income into their children's names just to use their personal allowance and their basic rate bands. But once they're an adult, that's fine to do that. So it's only if they're a minor under 18 would income earned from the asset transferred from their parents be taxed on them. So it might be worth briefly mentioning that point. Very difficult point to pick that one up. So then we've got that. So we've got the income tax there. I mean, you could even work out, because you've got the amount of the dividend and the tax they'll pay, you could even work out how much cash you'll be left with. I mean, the children, the wife will be left with this amount. The Anna herself will be this, minus by the tax that she has to pay. We didn't really ask for that, the net amount of cash that they would be left with, but you could mention that. So then we were told, so that was a dividend would then be paid out. So when Lexi and Ty want to start their own businesses or purchase a property, the company will sell some of the assets to provide the necessary cash. So if the company sells these assets, if a company sells a property, or if a company sells, shares that it has, then of course it's going to have gains on those. So of course, when we looked at corporation tax before, and we've got, a company with gains, once again, always think about, are there any reliefs available when we're thinking about, chargeable gains? But again, it's mainly for trading assets. If you're thinking about, land and buildings, so property, then if there's like a replacement trading asset, but there isn't, it's a residential property, so that's just going to be taxed. And then again, if you're thinking about shares, think about SSE. Whenever you've got a company selling shares, will they qualify for SSE? I mean, unless they're buying shares, they're going to be holding 10% of the shares in these companies. We don't know which companies they're investing in, but of course, if they're like big listed companies, then obviously they're not going to be holding 10% of those companies if they're only investing £800,000. So probably SSE is probably quite unlikely. So you can say when company sells property and shares, company will pay corporation tax on chargeable gains. SSE is unlikely to be available unless the limited company is holding 10% of shares in the investee company. So unless it'd have to have bought the shares in like a really small company if 800,000 is going to be 10% of that share capital. I mean, it's not that it's impossible, but it probably is quite unlikely. So if the company sells the assets, the company is going to have chargeable gains on the property and the shares, and then the dividend would be paid up. So again, there'd be income tax, when the dividend's paid up as well. So you could say income tax, payable on any dividend to Lexi and Ty. Could have mentioned that. So that's one suggestion there. So they sell some of the assets, and not all of them. So if they sell the property or sells the property, or some of the shares, so there would still be some shares in the company or some property in the company. And then we're told once the children are established in life, Kira and I will transfer our shares to them. However, I am unsure whether we should transfer our shares in our lifetime or on death via our wills. So again, we've kind of got this situation here where you've got an individual who's got an asset. So the parents each have shares in this company and they want to transfer them to the children. And the question is, do we transfer them in life or do we transfer them in death? Very common BPT exam question, this. So let's just think back to our CGT and our IHT matrix. If you transfer it in life shares, is it going to be exempt? No, it's not an exempt asset. It's not a trading business, so there isn't going to be gift relief available, or business asset disposal relief available. So it looks as though it would be subject to CGT. So if you think if it's a life transfer, so you can say transfer of shares will be a gain for CGT. And you can say, once annual exemption exceeded, gain taxed at 10 slash 20%, obviously basic rate band if it falls within that, 10% or 20% if it's in the higher rate band. So of course we know one of them hasn't used their band and the other has. So you could say 10% for was it Kira, and 20% for Anna. So that's what would happen for a lifetime transfer. If they transfer, if a CGT, so if they transfer them in life for IHT, again, there's no transfer, there's no exemption there. They're not going to get business property relief because it's not a trading business. BPI, that has to be a trading business. Like with all of these reliefs, business asset disposal relief for trading businesses. But again, it'll be a PET, and kind of as the points we've made above there, really. It's going to be very similar to this. In fact, it's going to be the same as this. So if they transfer it in life, transfer, of shares, will be a PET, annual exemption available, nil rate band available. There'll be no lifetime tax to pay, and death tax will only be payable if they die within 7 years. No death tax if survives 7 years. So you can see how with IHT, it's quite good to pass it on life, because if we look now on death, so if they pass it on death, then of course, for CGT, death is the best way to pass things on, because it's not a disposal for CGT. So if they die and pass these shares on, it's not a disposal, so there'd be no CGT to pay. Not only that, but the recipient's base cost gets uplifted to market value on death. So this is really favourable treatment, because the person disposing of it isn't taxed on it. And of course, that can happen in other circumstances, like where you defer the gain by claiming gift relief. The difference between death and just deferring the gain is the recipient, so the children, their base cost, so their value for CGT purposes, so when they calculate their gain in the future, the cost that they can deduct is uplifted to market value on death. So really favourable treatment there. Whereas with like gift relief, yes, the person disposing of the asset doesn't have to pay tax now, but the base cost is reduced for the next person. So death is a really beneficial way to pass assets on for CGT purposes. And we went through this in detail in the earlier CGT and IHT planning classes. So we could put here, death, not a disposal for CGT, and children get shares at market value on death. And that's why it's sometimes called like a tax-free uplift, because the assets are uplifted to market value, but no one's paid tax on that increase. But what about IHT? This is generally, very broadly speaking, for IHT, better to pass on life. CGT, better to pass on death. It depends, based on what reliefs are available. But that's kind of generally the principle. We went through this in detail. We went through all of the different scenarios and things to consider, and it very much depends on is it an exempt asset for CGT, or is it an exempt asset, or is it covered by relief for IHT like BPR. So it very much depends, but kind of broadly speaking, then we could say that. So what will happen? So we've said if you pass it on death, then there'll be no CGT to pay. If in terms of IHT, then of course, is there going to be any reliefs? As we said, it's not going to be BPR, it's not residential property, it's not quick succession relief. So therefore, it's going to be IHT at 40%. If the nil rate bands have been used. IHT, we could say, IHT will be payable at 40%. Once nil rate band exceeded. So you can kind of see here, and I think this is where they kind of want some advice, because that's what they said they weren't quite sure on. We're not sure whether we should transfer them in life or pass them on death. We could have that with our recommendation below. But what we had here is this kind of typical situation where, okay, on death it's better for CGT, but it's kind of worse for IHT, because if you transfer it on life, yes, there'll be CGT, but there won't be IHT if they survive at least 7 years. So one thing you could do is, how could you either reduce the CGT here or reduce the IHT here? Well, there's nothing you can really do about the IHT on death. But we said here with the CGT that, there is the annual exemption available. So they could transfer like a small amount of the shares each year to use up the annual exemption. And that would be a kind of a good point to say. Or you could even say, actually, the fact that these rates are lower than the IHT, and you could possibly have done some calculations, but we've kind of got a lot here already for the marks. Because these rates will probably be lower than the IHT or the nil rate band, it would depend whether that's available or not. It would of course depend when they die because of that earlier transfer. But probably the best thing to say would be that transfer as much as you can in life within the annual exemption. So transfer the shares kind of a little bit at a time. So recommendation, transfer in life as likely to survive more than 7 years and avoid IHT. So you could say, transfer shares gradually to use annual exemption each year. So that would be one way to do it. So then, because the shares were kind of split up, there were quite a lot of shares. There were like 2,000 shares, so they could transfer them, a few shares at a time. So you can kind of see there with that option, we just kind of worked through it quite logically, like one transaction at a time, thinking, CGT and IHT and any other taxes which were relevant as well. Those small little taxes like stamp duty, thinking about VAT and national insurance, where that could be relevant as well. And you can see it was just about really thinking about it logically step by step, what's happening. First step, transfers cash to wife, transfers cash to children. So thinking of CGT and IHT on that. Step 2, transfer property into a company, CGT, on that. And then there was, companies going to receive rent income and dividend income. So of course we're thinking about corporation tax, rental income taxable, dividend income not, and then dividends paid out to individuals, obviously subject to income tax. So we knew their rates of tax. And then we briefly had at the end this typical question of, should I transfer my assets in life now, or should I wait and transfer them on death? And you can see that I've used that same exam technique that I always use, short, concise, range of points, covering all of the different taxes, calculating the numbers where I can, but then just picking up marks every time. So, I mean, we said kind of 15 marks. I've got more than 15 marks here. I definitely would have, we're roughly thinking about a mark per point. So, we'd have done really well on this first part here. We almost certainly have scored 4 marks. So then let's have a look at alternative 2. And just coming back to that. So even if I had missed out these harder points, I still could have got 4 marks. And therefore, it isn't essential to get all of the points in order to score 4 marks. It's really about exam technique, getting those easy and medium points down. And you'll see that, we've had several students who have scored really high marks, high 80s, high 90s. And they all say kind of it's about exam technique, getting the easy marks every time. So we've had students going from failure marks up to top marks, kind of like 96%. But you can see it's all about exam technique, where to pick up the easy marks, how to lay out the answers, how to use the open book notes in the exam. So it's not always about kind of getting the harder marks. It's about having a really good exam technique, really helping you pick up those easy marks. That's the key to doing well here. Getting 100% in this exam doesn't require you to be like a tax expert. It really does require good exam technique. And one of the things which is key as well is really using a scenario as much as possible, making sure that you really focus on the information that the examiners have given us. So here we've got like alternative 2, so setting up a trust. I will set up the court discretionary trust with the children as the beneficiaries. I will transfer cash of 800,000 and the buy-to-let property into the trust. The trust will use the cash to purchase dividend-paying shares and make regular payments to Lexi and Ty. So the trust is going to, so the individual So Anna is going to transfer cash and the buy-to-let property into the trust. So the trust will then have the assets. So the trust will earn the rental income, and it will, of course, use that cash to buy shares in companies, and therefore it's going to receive dividend income, and it's also going to have that rental income in it. And we're told that it's going to have the dividends, it's going to have the rental income, and then they're going to use that to make regular payments to the children. So they're going to get the dividends effectively being passed through the trust to them and the property income. When Lexi and Ty want to start their own business or purchase a property, the trust will sell assets and transfer cash proceeds to them. So I think trust is that topic which comes up that lots of students fear. But you just need a basic awareness of trust and some of the basic points around how trusts are taxed. So we're actually told that they're going to set up a discretionary trust, and that makes sense that they're going to use a discretionary trust, because that obviously means that the trust has discretion about when amounts are paid out. And we said that's one of the main considerations here. They want to retain some control over when the amounts are paid out to the children, presumably because relatively young children, they don't want them going out wasting the money or spending it on sports cars and things like that. So that's why in this company they retained control. They had the voting rights in the company, and they were the directors. So the children are entitled to some of the income, but only when the parents as directors declare a dividend. And the directors have the voting rights as well. So almost like a double security there. Similarly here, they haven't transferred the assets to the children. They've put them into a trust, and presumably they'll be the trustees, or they'll appoint trustees, and the trustees will pay income out when they decide to, when the trustees decide to. The children, they don't have a right to the income like they would in an interest in possession trust. When the beneficiaries, the children, would have a right to the income that's being earned in the trust. The trust earning its rental income and a dividend income. If it was an interest in possession trust, they'd have a right to it. Or if it was a bare trust, they would effectively just basically own the assets. It's effectively transparent. But with a discretionary trust, then the parents have some control over when the amounts are paid out. So you can see why they set up the discretionary trust. So again, we can think, let's think about this logically step by step. So what happens first of all? We're going to transfer cash and a buy-to-let property into a discretionary trust. So of course we know, and even back from our basics from TC, that obviously when an individual transfers an asset into a trust, it's going to be a CLT. So it's going to be lifetime IHT to pay on this. We probably can do the calculation as well. We're not told that the trustees pay the tax, so we'll assume that they're going to pay the tax themselves, that the transfer, or the Anna's going to pay the tax herself. So you'd have the value of the transfer, no reliefs available, annual exemptions again, nil rate band, but we know it's going to be subject to IHT at 25%. I mean, you could even do them both together. I guess technically they are two separate transfers. But we could say, transfer to discretionary. So you could even put here, discretionary trust is a CLT, so lifetime IHT to pay on transfer value which exceeds, and you could put annual exemptions and nil rate band. So we could actually work that out. I mean, we've got the two transfers here, haven't we? We've got the cash and then we've got the property as well. So the cash was 800k. So then the annual exemptions, assuming they didn't use it from the previous year. So we'd have this here. Then there'd be the nil rate band. We'd need to know if she's made any transfers in the last 7 years. So you could put that here, need to know if any transfers made in the last 7 years, because that of course reduces the nil rate band by those gross chargeable transfers. So it would assume that the full nil rate band is available. So I mean, yeah, it could suggest some tax planning here that maybe she could have transferred half of it to her wife first of all, and then you'd be able to use both of their nil rate bands. But you could mention that, and it would be a valid point, and you would get a mark for it. But here you'd have the IHT that would be payable on that 25%. So need to know if transfers made in the last 7 years and if Anna or trustees will pay the IHT. Presumably it's going to be Anna. So and that's what we've kind of assumed there. And then they're going to do another transfer of the property, which was worth 390k. Obviously, there's no annual exemption because they're doing this transfer and then presumably this one straight after. The nil rate band's been used. I mean, technically, you've got a nil rate band of 325 reduced by gross chargeable transfers in the last 7 years, and there was one, just a month ago of this. Plus the IHT they paid on their behalf as well. So definitely no nil rate band available there. So that's going to be IHT at 25% as well. So there's going to be a lot of IHT under this alternative already. Didn't have all of this IHT with the company option. So transfer to a discretionary trust, CLT, lifetime IHT, need to know if any transfers made in the last 7 years. And you could even mention, if they were to die within 7 years, then it'd be IHT again, 40% reduced by, taper relief and lifetime IHT paid. But it sounds as though, as we said, there's no mention of them, dying anytime soon. So you could briefly mention that point because that is, of course, how a CLT lifetime transfer works. But that didn't seem to be it didn't seem that we had to really kind of consider the impact on death that much. So of course, this is a life transfer, and of course we thought it's gone into a trust. That is going to be a CLT for IHT, tax 25%, and then we could mention if they survive 7 years. There weren't any other reliefs here for those assets. But then for CGT as well, this is also, I mean, the cash is exempt, so you could mention that. So cash is exempt for CGT, but the property isn't. So there's going to be a gain on the property because, Anna's disposing of the property to a trust. So there's going to be a gain on the property, but there is a relief available. If there's an IHT charge, then there's a special type of gift relief. So this isn't the same type of gift relief as when you've got an individual disposing of shares in their personal trading company, or their their unincorporated business. So this isn't the same as this gift relief for business assets, when you've got, it's kind of similar to business asset disposal relief, when you've got somebody disposing of either their shares in the company that they've got 5% of the shares in, or trading assets in their unincorporated business. So whether they've set their business up as an unincorporated business or they've set it up as an incorporated business, relief is available when they dispose of. If it's an unincorporated business, they obviously own the assets, and if it's an incorporated business, they own the shares. BADR and gift relief both apply in those circumstances. But there's another type of gift relief, and this is like gift relief when IHT is due. So it's a special type of gift relief. If there's a lifetime IHT charge on the asset, then the CGT is deferred, because otherwise it would be a lot of tax on this transfer if transfers it into a trust, has to pay IHT and also CGT as well. So that's why that relief is available there. So we could say, disposal of property gives rise to CGT. However, because there is also a lifetime IHT charge, gift relief is available to defer the gain for CGT. So of course, in theory, what happens here, what's really happening is it's disposing of the property, has this gain. So proceeds minus cost equals gain. However, there's this special type of gift relief which is available, so it doesn't have to pay tax on the gain now. But like all of these CGT reliefs, usually the next person would get it at the market value when it was transferred to them. But if the person has claimed a deferral relief, like gift relief, then of course that reduces the base cost of the asset. So you can see that the trust's base cost is just going to be the same as what Anna's original base cost was. So you could briefly mention that. We covered that in a lot of detail in the CGT classes when we looked at lots of questions of the reliefs, when to claim the deferral, when not to claim the deferral, but you can just see it being relevant here as well. So dispose of the property gives rise to CGT, however, can claim gift relief to defer the gain. And then you could put, base cost for the trust is reduced by amount of gift relief claim. So it's really important, as we covered in those CGT classes, it's really important you understand this concept of base cost and when it gets reduced by these CGT like deferral relief. So really important to appreciate that there. So with all of these tax deferral relief, it reduces the base cost of the next asset or the asset for the next person. So that was probably the main bit there. So we felt CGT and IHT on that life transfer. So they're transferring the cash and the property. So the trust will use the cash to purchase dividend-paying shares and make regular payments to Lexi and Ty. So as we've said, the trust is going to have rental income, and the trust is also going to have dividend income as well. So we can think about how the trust is taxed. So the trust will pay income tax. This is a discretionary trust, so it will pay tax on the income. So it's got a £1,000 basic rate band, but the rest are additional rates. So look at the rates relevant for your exam, but for exams in 23, then property income is going to be taxed at 45% and the dividends at 39.35%. So we can say, trust will pay income tax on property income and dividends. We can say property income will have 1K at basic rate, so 20%, and remainder at 45%. Dividends all taxed at 39.35% because it's only got a £1,000 basic rate band. So we can see that there. And then the trust will pay the net amount out to the beneficiary. So, I mean, you could even do some calculations here as well because we know what the property income and the dividend would be. I mean, we've got plenty of points down, in here already. But, we could have that because we've got property income of 12,000 and we've got dividend income here as well. So you could go through and work it out because you'd obviously have 1,000 at 20%, then the rest will be at 45 and the dividends will be at 39.35%. So you could work out what the tax would be on each of those. So the rest of the property income at 45 and then the dividend income at 39.35. So then you'd have the total tax, and you could work out what would be left and what would be paid out to the children of that 50,000 of income. Quite a substantial amount of income tax there for the trust, of course, because it's all at those additional rates. So that's the amount that would be paid out as a dividend to the children. But of course, in the interest of time, I might not have time to do all of this. So that would be paid out to the children. But they pay income tax. So in their income tax computation, dividends go in at the gross amount, but then they get a tax credit for the amount of tax paid by the trust. So this is quite tricky how this works. So, what will happen is they'll record the gross amount of the dividend in here, and then they'll have a tax credit for the amounts of tax paid by the trust. And I think, with all the points we've got down already, I think it would be sufficient just to kind of explain this. We could have these few points down there. So you could say, you know, trust pays net income of, you know, roughly 30K to children. Children taxed on gross amount with tax credit for income tax paid by the trust. So you could have got just a few points down there. I mean, you could even possibly have mentioned, you know, the tax pool, but yeah, just some of the main points really around trusts and how that would work. So then that's how the trust would be taxed. So again, you can see, you know, quite different from the company, and they're paying tax at the like additional rates on those dividends, whereas, you know, the company, the dividends were exempt. The, you know, rental income was taxed at the main rate for corporation tax, and here it's being taxed at the additional rates for income tax. And then we were told when they want to start their own business, the trust will sell the assets and transfer the cash proceeds to them. So a few other points to note as well. You know, we said when the trust is first set up, so for CGT, be a relevant property trust. So when it was set up and the assets were transferred, we said, of course, you know, at the time when the assets are transferred, that will be a gain for CGT, but there'll be gift relief if there's also an IHT charge, which is what we saw there. Now, if the trust were to sell the assets, it would be taxed on those gains at the usual rates of CGT, but the annual exemption will be reduced by half. So if the trust sells one of these assets, so either the shares or if it sells, you know, the property, it will be taxed at the usual rates, but the annual exemption will be reduced. So we can say, you know, when trust sells assets, CGT payable, so you say annual exemption will be half of, you know, usual annual exemption. So whatever the annual exemption is for your exam, then to reduce it by half. Trusts have half of that. So we can think, you know, for CGT, if the trust sells a property, that would of course be at the additional rates. So you can say, you know, property will be at additional CGT rates of, you know, 18%, 20%. Shares will be at 10% and 20% additional rates, of course, for property. So when the trust sells the property, they'll be taxed on their gains like usual. Obviously, if it just sells an asset, you know, there's going to be no IHT there. But, you know, when the property passes from the trust to the beneficiary, so we're told here in the question that the trust would sell the assets and then transfer the cash proceeds to them. So when property passes from the trust to the children, then we think CGT, but of course it will be cash because the trust is going to sell this, sell the shares, and then it will just have a load of cash in it that it would pay out to the children, but that would be exempt for CGT. So if we think about IHT, as we said, you know, when the trust is first set up, it will be a relevant property trust. So when the trust is set up and the asset transferred, there'll be CLT payable by the parent, and we discussed that, you know, when it was transferred in, there was CLT payable by the parent. Now there'll also be IHT on every 10th anniversary. So we could have mentioned that. We perhaps should have mentioned that up here actually when we did the initial transfer. So the transfer to the discretionary trust, so when the parent transfers it into the trust, that would be a CLT. And we calculated that CLT, but we could have mentioned here as well. So you could say, in addition, every 10 years, there will be an IHT charge. So we said there was loads of IHT when it was kind of transferred in the first place, and then every 10 years there is. Now, when the property is then transferred out to the children, so the trust will sell the property, but will have a load of cash in it. Now, when that cash is transferred out, yes, it's exempt for CGT, but it's not exempt for IHT. So there'll be an IHT exit charge. So it'd have here, so when the trust sells the asset, CGT payable, and then we say, you know, when cash transferred from the trust to children, no CGT because cash an exempt asset. However, there will be an IHT exit charge. Now, you don't need to know the calculations for the IHT exit charge, and you don't need to know the calculation for the 10-year anniversary charge either. But you just need to be aware of them, and you can see why they would be relevant here. So if we just kind of just recap those, I mean, the trust gets really difficult when we talk about easy marks, medium and hard marks. That is kind of hard marks. So let's kind of think about, big picture, what essentially was going on here. We had a parent who owned a property, so a buy-to-let property, and had some cash essentially, and they wanted to provide some income for their children and then eventually transfer big capital amounts to them as well, but they wanted to retain control. So they didn't want to just pass the assets to the children. The parent wanted to retain some control, and that's quite common because they obviously don't want the children going and wasting all of the money. So one option was to set up a company. So they're going to set up a company where they are all shareholders. Now, in order for the children and the wife to be able to subscribe to the shares, this parent who had the money transferred it to them. So this was exempt for CGT and exempt for IHT because it was a spouse. Transfer of cash to the children, PET for IHT. So then they were all shareholders in this company, and they subscribed the cash to the company. So the company had cash in it, which it used to buy a portfolio of investment shares. Now, the parent also transferred a buy-to-let property into it. So that was CGT here for this parent. So we calculated the CGT there for the parent. And there was also stamp duty. So as I said, stamp duty, VAT, and NI, smaller taxes, but keep a lookout for them in the exam. So the parent had a gain there. So then we had a company which had a property in it and a portfolio of shares. It received dividend income. We know dividend income for companies is exempt, and it had property income. Now, because it was a close investment holding company, it would all be at the main rate of corporation tax. So the company, because the company owns the assets and the company's earning the income, will be paying corporation tax. And then the amounts are going to be paid up to the shareholders, and therefore they're going to receive dividends. So the company would pay corporation tax, and then the individuals pay income tax on the dividends. And we could work out what those dividends would be. And then we were told when the children need a significant amount of money, like a lump sum, then a company could sell some assets. But of course, the company's going to have gains on those assets, land and buildings, and selling shares. We thought, would SSE apply or would rollover relief apply? Probably not. So it'd be there'd be corporation tax to pay for the company. So we put corporation tax at 25% on any gains. And then if the amounts are paid up as a dividend, they'll obviously be subject to income tax. The other question here was, the parents own the shares in the company. When should they pass them on? Should they pass them on to their children in life, or should they pass them on death? And then we kind of thought, and that's that typical dilemma we have in a BPT exam, should they pass the assets on in life or on death? And then we went through, the options there. You pass the one on life is going to be a gain for CGT, but for IHT, it's going to be a PET. So as long as you survive 7 years, there'll be no IHT to pay. If you transfer on death, that's going to be better for CGT because it's not a disposal, but there will be IHT. And therefore, we decided to transfer them a little bit at a time during life. So the annual exemption covers it. And then, look after yourself so you don't die within 7 years, and there'll be no IHT to pay either. That's what we decided there. Now, alternative 2, is essentially the same thing. The individual's got the same assets. They've got the same assets here. But what we were just kind of thinking here, or what was happening here, is they were being transferred into a trust. So in a way, it was kind of similar in that they wanted the children to benefit, but they didn't want to give them to the children directly. So rather than kind of setting up a company to hold the assets, they transferred them into the trust. So of course, when the cash and the property is transferred into the trust, that gives rise to IHT. And that's what we didn't have in his first circumstances. On those initial transfers, there wasn't any IHT. There was no transfer when the property was put into the company. And there was no IHT when cash was, transferred so they could buy the shares in the company. Whereas with this trust, there's that immediate IHT charge because it was a chargeable lifetime transfer. And that was the big disadvantage really here of the trust. And there was huge amounts of IHT to pay, hundreds of thousands of pounds. Yes, there could have been a bit of planning done where she could have transferred, half of these assets to spouse first of all to benefit from, the other nil rate ban, but it still wouldn't have covered it all, and there would have been a lot of IHT to pay. So not only is there IHT to pay when the trust is, set up. So when the trust is set up, it's going to be a CLT, like we said, we know, that's when a CLT applies, when it's transferred into a trust, as you remember from TC. You just didn't really need to know about trusts in any detail at TC. So when the trust is first set up, then yes, it's going to be a CLT. But not only that, there's going to be this 10-year anniversary charge as well. So even just by having these assets in the trust, these shares in these investments and the property, there's going to be like an anniversary charge, IHT charge on the value of the property in the trust. So an immediate IHT charge for transferring it into the trust, the assets into the trust, then a 10-year charge. So then we also had, CGT. So because they were transferring, one of the assets was subject to CGT, the property, as we discussed previously, as when it was transferred into a company. So it's going to be CGT to pay when it's transferred in. But with the CGT, because there was an IHT charge, there wasn't, or the CGT charge would be deferred. So because there was an IHT charge as well, then the CGT was deferred. So actually, when it was transferred into the company, the CGT was payable. So there was going to be CGT payable there of the 27K, and that wouldn't be payable with the trust scenario because it would be deferred, but instead it'd be these huge amounts of IHT to pay, which were clearly higher. And also, even though the CGT isn't payable, the base cost of the asset is reduced. So it's not as though that gain is exempted, it's just reduced. So that's what happens when they're transferred into the trust, as we saw there. Now, when those assets are in the trust and the trust is earning that income, so the rental income and the dividends, that's taxed at predominantly the additional rates of income tax, which are very high. Contrast that with a company and the dividends were exempt and the rental income was at 25%, which is quite high. But of course, we said with the company, obviously interest expense on a mortgage, would be deductible as well if there was one. So there was then higher rates of tax when it was in the trust. And then we had, like the exit plan, if you like, the trust would sell the assets. So the trust would pay CGT when it sells the assets, which actually, when the company was going to sell assets to give the children lumps of cash, that would be corporation tax at 25%. Whereas here, where we saw, some of these assets, yes, the property is at higher rates, 18 and 28%, but the shares are at 10 and 20%. So actually, that's lower than the corporation tax rates. But this additional rate is obviously higher than the corporation tax rate. So not too much difference there in terms of when the assets are either sold by a trust or sold by a company. And then when the amounts are paid out, there'd be taxed as a dividend on the individuals here. But when they're paid out of the trust here, there'd also be additional IHT charges. It'd be the IHT exit charge when that was paid out. So really the key difference is there's a lot more IHT with the trust scenario than there is with the family investment company. And a lot of that tax was paid up front when the assets were transferred into it. So maybe as our recommendation, and we should always have a recommendation when you've got different alternatives, so you can say, advisable to use family investment company because there is considerable IHT to pay with the trust, and this will reduce cash available for investments. as well. You could put something like that, but even just say, because there's considerable IHT to pay with the trust, and you could, I mean, this was 25 marks, and we've already got, plenty here to get full marks, maybe even enough for a 30-mark question. You could even possibly have kind of like summarized it all to compare the differences between, the family investment company and, the trust, because with a family investment company, you had the CGT that the parent would pay when it was first set up. But with the trust, of course, you had those huge kind of IHT when the property was transferred into the trust. So we had that total amount there, the 200,000 there, so considerably more. And then you could think as well about the corporation tax and the income tax, so the corporation tax on the rental income and the property income compared with the trust, the tax on the dividends. I mean, there was some tax on the dividend for the parent there as well, and then like the IHT exit charges, which we wouldn't have calculated, but you could have summarized there as a difference, and clearly there was a lot of IHT going into that trust, and that would be a good decision to do that there. And we actually saw with the family investment company, it did actually look as though really they were going to avoid, or they could avoid paying any IHT on it. They could pass all those assets on to their children without really paying any IHT, because transferring the cash, if they survive the 7 years, that's fine. So the children have got the shares without any IHT. And then there's the remaining shares held by the parents. But we said if you transfer them in lifetime a little bit at a time, that will avoid CGT. But then as long as you survive 7 years, that will avoid the IHT as well. Whereas with the trust, there's IHT payable as soon as you set it up. So this question follows on quite nicely from those capital taxes classes we looked at earlier. We looked initially at all the CGT reliefs and questions around that, whether to claim the deferral relief or not. And then we looked at a lot of IHT and CGT planning questions, including with some trusts in them as well. So it does clearly fit in kind of really well with those classes. So the family investment company is a new area from 2023. So it's something we do expect to see examined in upcoming BPT exams, but don't be too put off. And also kind of with trusts as well, a lot of students, it is quite a difficult area technically in terms of trusts, but you can see, and as we saw in the earlier classes as well, when I worked through other questions on trusts, you can see that there's plenty of easy marks to get along the way. The open book notes that we use will really help as well. So if you've got those available, so these are available on our website, they're really useful to have in the exam. As you saw me, using there, it's just really handy to be able to just go away and look at the main points that we need to consider making if it's relevant to the scenario. So after this class, maybe go away and watch back those other classes where I worked through questions on CGT and IHT, and go to the question bank and practice a few more of those questions as well. But there's obviously an element of corporation tax in here as well, because of course we're looking at companies. We've got the family investment company, and it did kind of tie in a little bit as well to close companies, which we covered as part of the common exam scenarios, and of course just using a bit of the basics from corporation tax as well. So it probably is more of a kind of common exam scenario, but obviously using CGT and IHT heavily here, but there wasn't really much new in terms of, or there wasn't anything really new in terms of technical content. And you can see, like, once again, as I've said throughout the course, it's really about interpreting the scenario correctly and really appreciating like who is transferring what to who, who's an individual, who's a company, who's transferring what to who, what's their relationship, what's the type of asset. And then you can start to see which reliefs are available, which type of taxes will be paid. Is it a company, corporation tax? Is it an individual, CGT, IHT, etc. And if you kind of got a nice little summary like this, it's easy to identify the relevant points. But it's so important that you focus on the scenario, like who is it we're advising, what is it they own, who are they transferring it to? What type of asset is it? And therefore, what type of relief supply? Really important you focus on a specific scenario that the examiners have given you. You know, every question is different. And as you've seen, me throughout the course, I say this with every type of question, but it's so important that you focus on that scenario, use the information that the examiners have given us, identify all the relevant taxes. So almost like keep all of the taxes, in the back of your mind, personal taxes, income tax, CGT, IHT, and obviously corporation tax for companies. They're the main ones, but just remember, national insurance as well, which usually follows an income tax charge for employees and self-employed, VAT and stamp duty, so stamp duty on shares and stamp duty on property, and VAT quite often, we see it on property in the exam. But making sure that you kind of just think of all of the relevant taxes, you can bring them in, and they're the gateway to the marks. But definitely with these capital taxes questions, really thinking, CGT and IHT, make sure you cover both of them. If you only did CGT here or only did IHT, you'd be like limiting yourself to half of the marks. So, as I said, go back and watch the other videos on these topics. So you can see me work through some other questions, and then you can go away to the question bank, and we've got a list of the questions in our materials. So you can go away and you can go and practice some of the other questions as well on those CGT, IHT style questions.